SIF or SIF stands for Specialized Investment Fund, a new category of investment vehicle introduced by SEBI in India to bridge the gap between mutual funds and portfolio management services. It targets high net worth individuals and experienced investors who were seeking more flexible, innovative, and higher risk investment opportunities over traditional mutual funds but with lower entry threshold than PMS. SIF offer a regulated alternative for sophisticated investors to access specialized and high growth sectors with professional management and oversight, aiming to reduce unregistered and unauthorized schemes. Main benefits of investing in SIFs: higher return potential, as SIFs use advanced asset allocation and flexible strategies such as long-term equity, short-term equity, and sector rotation, which can outperform conventional mutual funds in dynamic markets. Second benefit is an enhanced flexibility. Investors can choose from open-ended, closed-ended, or interval funds and access a wide range of asset classes, including equities, debt, real estate, private equity, and emerging sectors. Third benefit is greater diversification. SIFs allow investments across multiple sectors and asset types, helping reduce risk and increase portfolio stability. Fourth benefit will be professional management. Experienced fund managers oversee SIFs using deep market knowledge and strategic risk assessment to optimize return. Fifth benefit is access to niche and alternative investments. It provides entry into sectors and strategies typically which is unavailable in traditional mutual funds such as technology startups, green energy, and structured products. Sixth benefit is regulatory oversight and investors protection. SIFs are regulated by SEBI, ensuring transparency, risk controls, and compliances, which helps to protect investors. Next, about liquidity options. Closed-ended SIFs are required to be listed on stock exchanges, offering additional liquidity avenues despite longer redemption periods compared to mutual funds. SIF offer broad flexibility and can invest in including large cap, mid cap, and small cap stocks, sector specific equities, and through strategies like sector rotation fund. Across various sectors, including sectoral debt funds that invest in at least two industries with a cap on exposure to any single sector. Direct or indirect investments in real estate too. High growth, high risk sectors such as startups and unlisted companies. Investments in infrastructure projects and related instruments. Through hybrid funds, SIF can also allocate commodities and commodity derivatives, including real estate investment trust, infrastructure investment trust, and distressed assets. So, SIF particularly attractive for investors seeking exposure to high growth or niche sectors such as clean energy, technology, startups, and private equity, which are less accessible via traditional funds. Their flexible infrastructure allows fund managers to pivot strategies and sector-based market opportunities and investor objectives. Main risks associated with investing in SIFs are high volatility and market risk, as SIF often use advanced strategies like leverage and derivatives, making them more volatile than traditional funds and highly sensitive to market swings. Second, complexity and execution risk. The sophisticated strategies require deep expertise. Poor execution or incorrect market calls by fund managers can lead to losses. Third, credit and liquidity risk. Exposure to niche sectors and less liquid assets can make it difficult to exit quickly, especially during market stress. Fourth, limited track record. As a new asset class in India, SIF lack a proven performance history, making it harder for investors to assess potential outcomes. Next, higher fees. SIF may charge higher management and performance fees compared to traditional mutual funds, impacting net returns. Sixth, risk of mis-selling. Given their complexity and hype, there is a risk that SIF may be misrepresented to less sophisticated investors. 7th, conflict of interest. Potential conflicts between fund managers and investors must be carefully managed to protect investors' interest. So, SIF are best suited for experienced investors who understand these risks and can tolerate potential losses. Investors can mitigate risks in SIFs through diversifying investments. Spread your capital across different SIFs, asset classes, and strategies to avoid concentration risk and reduce overall portfolio volatility. Next, through due diligence. Carefully research the fund's strategy, portfolio composition, and the track record of its managers before investing. Ensure the fund's objectives align with your financial goals and risk tolerance. Third, monitor regularly. Review your SIF investments periodically to track performance, risk exposure, and compliances with your investment objectives. Fourth, understand regulatory safeguards. Leverage SBI's built-in risk controls such as caps on derivative exposure, single issuer limits, and sectoral exposure restrictions, which help prevent excessive risk taking. Fifth, use professional advice. Consult with financial advisors to understand tax implications, liquidity profiles, and the complexity of SIF strategies before committing funds. Sixth, focus on liquidity. Check redemption windows and lock-in periods, as SIF may have less frequent liquidity than mutual funds. By combining diversification, due diligence, regular monitoring, and professional guidelines, investors can better manage the risks associated with SIFs while taking advantage of their potential benefits. To protect investors, SIFs are regulated under SEBI's mutual fund regulations, ensuring robust investor protection, transparency, and governance. A minimum investment of 10 lakh is required, which limits participation to sophisticated investors who are better equipped to understand higher risk strategies. Strict limits are placed on single issuers and sectors such as caps on investment in debt securities by credit rating. Only mutual funds with a proven track record and clean regulatory history can set up SIFs, and experienced professionals must manage these funds. Transparency and disclosure. SIFs must provide clear disclosure about risk, investment strategies, and performance, enabling informed decision making. And SIFs are required to maintain separate branding and dedicated website to reduce confusion with traditional mutual funds and enhancing accountability. Redemption and investment rules are designed to protect investors from sudden liquidity risks and ensure fair treatment. These measures collectively provide a transparent, well-governed, and risk-mitigated environment for investors in SIFs, balancing flexibility with strong safeguards.